Now, the agenda in today's session is to discuss revenue recognition, expense recognition, and accruals and deferrals. That's it. Those three things, right? So if we go over the schedule so far, we have discussed the basics and fundamentals of accounting, the conceptual framework, balance sheet, income statement and OCI, cash flows, statement of changes in equity, notes to account, and SEC reporting requirements. Now, before we move on to long-term construction contracts till to next session, in today's session, we'll discuss revenue recognition, expense recognition, and accruals and deferrals. That's the agenda which we'll have. Now, we had already discussed revenue recognition briefly when we were discussing income statement, the 5-step process. We will discuss it again in much more detailed manner. Now, earlier, if I talk about prior to 2017, 2018, before the new standard came out, the revenue recognition was different for different industries, different for different products, different for services. So you had multiple revenue recognition standards. Now, what the new standard did, what the new recognition standard, I think you don't need to know it as a new standard. This is the only standard you need to know. The new recognition standard, what it did was it consolidated and gave a unified approach to recognize the revenue. There's 5 steps. You follow these 5 steps and you're done. And that's the entire contract. That's it. And it's the entire process to recognize revenue. Now, the first step is you have to identify the contract with the customer. You have to. So, and you can think of any service or any product in the world or any transaction in the world, and the revenue recognition will follow only these 5 steps. Only these 5 steps. That's it. So let's just say there could be something as, let's just say, provision of CPA review sessions. Now, that's the contract which we have identified. Now, what is the performance obligation in the contract? Let's just say the performance obligation which we have, is provide books, notes, MCQs, let's just say Excels. The other provision which we have is provide, let's just say, live tutoring. Let's just say the transaction price we've allocated to it, let's just say, is $10. Now we allocate this $10. So let's just say the moment you enroll, we transfer you permanently the books, the notes, MCQs, and Excel, such that the transaction price enrolled or the transaction price allocated to the books, notes, and MCQs and Excel would be $7. And transaction price allocated to the live tutoring would be $3. Now, when was this done? Immediately on enrollment, you get the books, notes, MCQs, and Excel, let's just say. And this is not the model with Ninja, but let's just say immediately you get the model books and everything. So immediately on enrollment, you can recognize the revenue. Live tutoring, as and when you provide, you would recognize a portion of revenue. See, here what is happening is our performance obligation is getting satisfied over a period of time, because we'll provide the live tutoring and you will enjoy the service as and when you're getting it, such that the performance obligation is satisfied over a period of time, and the revenue would be recognized over a period of time. That's one example of the contract which we followed. Let's just say the second example could be, let's just say you want to get the furnitures, custom made furnitures for your house, right? Now, or let's just say you want a house with custom made furnitures. You want a house which is built with custom made furnitures. So the contract is to provide a house with custom made furnitures. Right? The performance obligation in the contract for would be land. So you're obviously purchasing a land for the client, building the house, furniture, or let's just say building the furniture, constructing the furniture, and warranty on all products. Warranty on all products. Now, providing a house with the custom-made furniture, the total build amount, the total contract price is $600,000. Now, of which land has been allocated $300,000. Building the house has been allocated $200,000. Constructing the furniture has been allocated $70,000. Warranty on all products has been $30,000. So if you see, the first step was we identified the contract. We identified each performance obligation. It's not one performance obligation. The seller has 4 performance obligation: getting the land, building the house, constructing the furniture, and providing warranty on all products. These are the 4 obligations which the seller has. This is the total transaction price. And we have allocated the transaction price to each performance obligation. Now we'll recognize revenue. Now, the moment you build the land, the moment you purchase the land, not build the land, the moment you purchase the land, this can be recognized. Recognize on purchase of land, because you purchased the land for the client itself. Once you build out here, once you're building the house, while you're building the house, can the purchaser, we'll be discussing this in much more detail in the next session. But just to answer, think about it and answer. When you're building the house, can the buyer enjoy or live at the house? What do you think? When you're building the house, can the buyer? Buyer can't. And if you think there's a difference, right? Earlier with live tutoring, which is done over a period of time, the purchaser or the buyer could enjoy the service while the services are being performed, such that we recognize revenue over a period of time and performance obligation was satisfied over time. But here, until the entire project is complete, the buyer cannot enjoy anything, such that for him, performance obligation is satisfied at a point in time, such that recognize revenue when house is complete. Same with furniture, recognize revenue when furnitures are complete. And finally, warranty. Now, warranty is for a period of 2 years. So recognize revenue, recognize warranty revenue after completion of 2 years. Why? Because after 2 years, the warranty has expired. Now you have earned the revenue. For the 2 years until the passage of time is completed, you cannot. So let's just say you can recognize 15,000 in 1 year, $15,000 in another year. That's how warranty works. Are we clear with this, everyone? This is the revenue recognition process. Any questions on the revenue recognition process? Any doubts you have? Any other example you could think of which you would want me to do again? Okay. Now, expense recognition. Now, as we discussed in the first session, that is fundamentals of accounting, right? Expenses are